In this video, I'm going to show you how to invest in the stock market the simplest way possible. You only need two ETFs, VFV and VOO. Investing can feel overwhelming, especially if you're just starting out. When you search how to invest, all you see is big numbers or market news that make you feel like the world is crashing, or videos telling you to buy this company now before it's too late. It's easy to feel stuck before you even begin. So I want to share with you a super simple way to start investing that doesn't involve picking individual stocks or spending hours doing research. If you're new to this channel, I'm Joyee Yang, a 26-year-old investor who specializes in simple investing methods that work. I talk about how you can make your money work for you using simple and realistic investing strategies, dividends, and other passive income strategies. VOO and VFV are my go-to stock ETFs for long-term investing, and I'll break down exactly why they're such powerful tools for building wealth. Not only that, but I'll also share how you can use tax-efficient accounts like the TFSA and RRSP in Canada to maximize returns and avoid unnecessary fees. I'll explain everything step by step in beginner-friendly terms, so by the end of this video, you can feel confident enough to take action today. What is VFV and VOO? Both VFV and VOO are ETFs, which means that they are funds that track the S&P 500 index, which is made up of the 500 largest companies in the US. When you invest in the S&P 500, you are essentially investing in the US economy, putting your money into companies like Apple, Microsoft, Amazon, and Tesla. Investing in the S&P 500 is one of the most reliable tools for wealth building because of two main benefits. One, diversification. Instead of buying shares in one or two companies, you're instantly investing in 500 of the biggest and most successful companies in the US. So you can achieve the most crucial goal of investing, which is spreading out your risk without having to overthink how to do it. Number two, time-proven long-term growth. Over many decades in the past, the S&P 500 has consistently delivered an average annual return of around 10% before inflation. Of course, the market has its ups and downs, but over the long term, the S&P 500, which represents the US stock market, has been a time-tested, long-term bullish asset. So it's a relatively reliable wealth-building tool for beginners. Both VFV and VOO are tracking the same S&P 500 index and gives you exposure to the exact same 500 companies. The main difference is that VFV is listed in Canadian dollars and trades in Canadian dollars, while VOO is listed in the US and trades in US dollars. So why are we focusing on these two ETFs? The simple reason is, if you live in Canada, these are the best investments to optimize your tax benefits. If you're a fellow Canadian resident, please say hi in the comment section. If you're in the US, VOO will be a great option for your Roth IRA as well. Let me explain. How I optimize tax benefits with VFV and VOO. Now let's talk about the part that most beginner investors don't realize until it's too late. Tax efficiency. If you're paying taxes in Canada, you'll want to invest in a way that minimizes unnecessary fees and taxes while maximizing your returns. That's why I use a combination of TFSA and RRSP accounts to hold VFV and VOO. If I were to restart my investment portfolio from scratch, my first no-brainer step would be buying and holding VFV in a TFSA. The tax-free savings account is one of the best tools for Canadian investors. Any capital gains you earn inside your TFSA are completely tax-free. So I use my ETF to hold VFV, the Canadian listed ETF that tracks the S&P 500. VFV trades in Canadian dollars, which means that I can buy shares of VFV straight away using Canadian dollars. I don't have to worry about paying currency conversion fees, so from switching my Canadian dollars to US dollars every time I invest. Any gains you make on your investment in a TFSA is 100% tax-free. For example, if you buy a share of VFV at $100 and you sell it at $120, the $20 capital gain is tax-free. You keep the $20 entirely. But here's a small catch that many beginners don't even know. Even in a TFSA, there's still a 15% withholding tax on dividends from the US. 15% only on the dividends you earn from holding US stocks. This is because VFV holds US stocks, and the US government automatically takes 15% of your dividend payments. Unfortunately, there's no way to avoid this withholding tax in a TFSA, but don't worry, the benefits of tax-free growth in a TFSA still outweighs this minor drawback. Dividends are what a company pays you just for buying and holding their stock. For example, if VFV is supposed to pay you $15 in dividends, only $12.75 will show up in your account because the 15% would have already been taken out. I'd much rather take the $12.75 of free money as passive income than stress over mitigating the 15% tax deduction. If I've maxed out my TFSA contribution room, which is the limit that you can check by logging into your CRA, I will turn to my RRSP, my Registered Retirement Savings Plan, for the next stage of my investing journey. I would invest in a FHSA if I can. That's the first home savings account, but I already bought a home, so I can't open one. People always ask me in my comments how to avoid the 15% withholding tax on their dividends. You guys are so sneaky, but there is a way, a legal way. Now here's where things get interesting. If you hold VFV, which is the US listed version of the S&P 500, inside your RRSP, you can completely avoid that 15% withholding tax on your dividends. This is because Canada and the US have a tax treaty that waives the withholding tax on dividends for investments held in an RRSP. For example, if you hold $1,000 worth of VOO in your RRSP and it pays a 2% annual dividend, that's $20 in dividends. Without the tax treaty, you'd lose 15% of that to US taxes, leaving you with $17. But in an RRSP, you keep the full $20. And over time, this makes a huge difference, especially if you're reinvesting those dividends. What that means is, if you're reinvesting your dividends, so when the company pays you dividends, you put the dividend back into the stock or ETF that paid it to you, which you should absolutely do, your money would compound faster if you're reinvesting $20 versus only $17. This is really simple math, right? Another benefit of the RRSP is that your contributions are tax deductible, which means you'll pay less income tax for the year. This makes the RRSP an incredible tool for long-term investing and retirement planning. So if you made $70,000 this year and you put $10,000 into an RRSP, you'd only have to pay taxes as if you only earned $60,000. The $10,000 is sheltered from taxes. However, I would prioritize maxing out my TFSA first because TFSA is way more flexible. You can withdraw money anytime for whatever reason without paying any taxes. And the contribution room comes back next year. The RRSP, on the other hand, is better for people who want to get tax deductions on their income, and only if you don't plan to withdraw that money in the near future, because you will get taxed when you withdraw it. I'm not a CFA, however, please comment what's the difference between all these registered accounts if you would like to see a detailed video explaining the key differences between TFSA, FHSA, RSP investing accounts, and which one to prioritize. So here's a recap of why I'm using the combo of VFV and VOO. By using VFV in my TFSA and VOO in my RRSP, I'm able to 1. Save on currency conversions when I invest in Canadian dollars. 2. Minimize the impact of withholding taxes on US dividends. And 3. Maximizing the tax benefits of both accounts while growing my portfolio efficiently. So in my TFSA, I'm saving money on conversion fees, although I do have to pay 15% withholding tax, but I don't care. In my RRSP, I'm not paying the 15% withholding tax, but I do have to pay for the conversion fees. This simple investing strategy fits my personality as well, as I always believe in making my money work for me. So I'd love to stay invested in long-term bullish assets for as long as I can, especially when these investments are paying me dividends. Now that we've covered the why and where to invest, let's talk about the how, or when. How to actually execute this simple investing combo using a stress-free method, and more importantly, stay consistent with your investing strategy in the long run. If you've been following this simple investing guide, please give this video a like. I'd really appreciate it. One of the biggest mistakes beginner investors make is overthinking when to invest. They're constantly waiting for the perfect time to buy, trying to catch market dips, or worrying about short-term fluctuations. But the truth is, no one, not even the pros, can consistently time the market. That's why I choose a simple investing strategy called dollar cost averaging. The DCA approach is all about consistency. Instead of trying to predict when the market will go up or down, you invest a fixed amount of money at regular intervals, like every week, every month, or any schedule that works best with your budget. Why DCA works so well with VFV and VOO? When you invest in ETFs like VFV and VOO, you're already diversifying across 500 companies. Pairing that with DCA creates a powerful combination for 3 reasons. 1, you don't have to time the market. With DCA, you're buying shares consistently, whether prices are high or low. This removes the stress of trying to guess when the market will dip or peak. 2, you automatically lower your average price over time. For example, if the price of VFV fluctuates between $100 and $120 over the year, DCA ensures that you're buying more shares when prices are lower and fewer shares when prices are higher. Over time, this smooths out your average cost. I have a DCA tutorial with a detailed mathematical example, so comment DCA and I'll send you the link to that video for a better explanation of this strategy. And 3, it keeps you consistent. The best way to grow your portfolio is to keep investing no matter what the market is doing. With DCA, you're building the habit of consistently putting your money to work, following a predetermined schedule. How I set up my DCA for VFV and VOO. For my VFV investments, I set up an automated monthly purchase through my broker using my TFSA account. This means I don't even have to think about it. It just happens automatically, like paying a bill. Once my TFSA contribution room is maxed out, I switch to buying VOO in my RRSP because VOO is in US dollars. I plan for currency conversions ahead of time to avoid surprises. The key to making DCA work is patience. The stock market will always have ups and downs, but over the long term, the S&P 500 has consistently grown. You can literally see my personal investment in VFV by following me on Blossom. It's a free social investing app. Many investors have been actively sharing their portfolio updates on Blossom, so don't miss out. Follow me now to get notified every time I buy and sell my stocks. Whether the market is up, down, or sideways, I stick to my DCA plan and keep my investing simple. That's what keeps me focused on the big picture, building wealth steadily over time using simple yet effective methods. If you've learned something useful today, don't forget to give me a thumbs up, hit that like button, and subscribe for more realistic investing content like this. You can go ahead and learn from my beginner investing playlist over here for more actionable tips. See you in the next video.